Hello and welcome back to The Note. Chinese stocks we know are cheap, but we also know that they're cheap for a reason. Has that created any opportunities? With me now to discuss this is the chairman of East Capital in Stockholm, Peter Elam Håkansson. Peter, thanks very much for joining me today. Let's start by taking a look at the gap between the H share market, companies quoted in Hong Kong, once known as red chips, and the A share market, which until recently was very much reserved for locals. There used to be an enormous disparity, now there's barely any. What's happened here?
Well, we've actually seen the valuation differences shrink and is now trading at almost the same type of valuation. And I think it's a bit unfair because the A share market is much more diverse and you have better growth companies, I think, there.
Okay, let's illustrate that now. So if we take a look, we can see that in the A shares, we have much more opportunity to play around with consumer discretionary stocks and also with healthcare and industrials, less of an emphasis on financials and energy. Why does that appeal to you?
I think it really is important to understand where China is at the moment. It's an economy which still has only about 35% of the GDP, which is private consumption, whereas most of the, say, Eastern Europe is around 70%. So there's room for growth there.
Okay, the great growth of the middle class is still at a much earlier stage.
Exactly. And then you want to basically be exposed to things like consumer discretionary and healthcare and industrial sector.
Is it fair to say that the A share market will be smaller as well? Generally, those companies will outperform in the long run, even if they're more volatile?
Normally they're smaller, and normally they're entrepreneur-led and driven, and that's one of the things which really are attracted of as well, that you buy those rather than state-owned enterprises.
Okay, let's start taking a look at valuation now. This is the CSI 300, which combines the biggest stocks in Shanghai and Shenzhen. Obviously, we had a true bubble back in 2007. We are as cheap as we've been in a decade. How do you go about valuing these stocks at this moment? Is it as cheap as that chart makes it look?
We think it is actually, and we spend a lot of time on the road traveling to see these companies and trying to meet management and see what is happening. And normally we are very positively surprised about the quality of the companies and the quality of the management.
Okay, let's put that valuation into some perspective now. Take me through what's happening in this chart. Obviously, it suggests that China A shares are vastly cheaper than the H shares that are available in the MSCI China index. What exactly is this chart telling us?
This is trying to look at the valuation of each of these asset classes compared to its own historics. So what it tells us here is that the China A share market is currently then trading at about half its historic valuation over the last 10 years. So if it were to go back to its average for the last 10 years, it has an upside of 93.2%. If you compare that to the MSCI China, which is the H share market, it's around 50%. And again, comparing it to emerging markets, they are more or less priced at the same historic valuation.
And meanwhile, the developed world, the S&P and the Dow are at records.
Yeah.
They look actively expensive. However, there are great concerns about a property bubble in China. Great concern. That's why banks are as cheap as they are in China. Are they not cheap for a reason? Are you confident that you really will not run into the kind of crash that many people are concerned about in Chinese stocks?
We think that the Chinese will continue to have a managed economy as it has been historically. And so that's one thing to start with. But also I think one of the attractions then with the A-share market is that you can diversify away from the banks in a much better way than you can in the H-share market. So if you are concerned about these things, there's plenty of opportunities in the A-shares.
And finally, let's talk about the catalyst for what would cause people to move to the A-share market. As it stands at the moment, the main indices that emerging markets investors benchmark themselves on don't include A shares,
Yes.
as I understand it.
Therefore,
are we waiting for index providers to give the go-ahead for a bigger move into A shares? Does this mean that index providers are too powerful?
Well, in one aspect, I guess they are, because they influence so much at the moment with so much ETFs and passive money all over the place. But I think it's also it's a signal. If the A-share market is included into the big indices of the world, that also means that it's an asset class that you should be investing in. And at the moment, there's very few investors in the A-shares. You have to have this kind of QFI license, which takes a long time to get, and you have to be appointed basically to run this. So it's still a market for very few players.
Okay, Peter, thank you very much indeed. Okay, if you feel like taking a risk on China, plainly there is a good argument for doing it in the A-shares market, particularly if MSCI catalyses a move into that market by changing the basis of its indices. Bear in mind, however, we are still talking about a market that plainly is cheap for a reason.